This is not a drill. Silver just blew past $65 and no one, I mean no one, is ready for what comes next. The banks are panicking. Vaults are empty. Industrial giants are paying over $70 off exchange just to keep the lights on. And while you are watching stocks and crypto, the most manipulated asset on Earth just lit the fuse for a generational short squeeze. This isn't a rally. It's a repricing. And it's already too late for most investors. But if you stay right here, I'll show you exactly why this breakout is just the beginning, and why $100 silver could be weeks, not years, away. 10. The Treasury just admitted they can't keep rates down. And that's a silver supernova trigger. Most people are still staring at the Fed for clues, but they're watching the wrong building. You want the real signal? You go straight to the U.S. Treasury. Buried deep inside the Q4 refunding statement, they quietly admitted something that should terrify every dollar holder on Earth. They're losing control of demand for U.S. debt. The Treasury's own auction schedule is ballooning, especially in the long end of the curve, while primary dealers are demanding higher and higher yields just to show up. That's not just a bond market tantrum. That's a structural crack in confidence. And here's where silver comes in. Every time the Fed loses control of rates, every time the Treasury is forced to issue more long-duration debt at higher coupons, that debt becomes unsellable in real terms. Because inflation isn't going away, it's going exponential. The CPI just clocked in above 4.1% annualized again, and that's with all the hedonic adjustments. Shadow Stats has real inflation running over 8%, so when the 10-year is yielding 4.2%, you're locking in negative real returns. But silver? Silver doesn't pay a coupon. It doesn't need to. It doesn't default. And when real rates drop into negative territory, as they're doing right now, silver rockets. Why? Because in an environment where debt is the product, and the product is collapsing in value, hard money is the only flight path left. We are entering the phase where the bond market loses discipline and the metals market gains it. This isn't speculation. It's history. In the 1970s, when real rates fell below 2%, silver went from $150 to $50. That's a 3,233% move. We are already in that window again. And the public has no idea. They're still waiting for Jerome Powell to pivot. They haven't realized the Treasury just waved the white flag. The debt is now monetized. The deficit is now permanent. And silver? Silver is the only exit door that's not locked from the outside. 9. The COMEX vaults are bleeding faster than ever, and the registered supply is a mirage. Let's talk metal. Physical metal. Not the digital contracts flying across the CME, but the actual bars that sit inside vaults with serial numbers and weight stamps. Because if you think $65.80, silver is expensive, wait until you realize you can't even get delivery at that price anymore. As of this morning, the COMEX warehouse report shows that total registered silver inventory, the stuff that's actually available for delivery, is down to 27 million ounces. That's the lowest level since 2016. But here's the twist no one's telling you, that 27 million isn't really available. A massive portion of those bars are already spoken for, leased, swapped, or rehypothecated in carry trades that nobody can unwind without blowing a hole in the derivatives book. Meaning, actual free-floating silver is closer to 10 million ounces at most. That's the entire supply for a global exchange meant to underpin a trillion-dollar industry. And just last week, 2 delivery requests totaling 3 million ounces came in from a single hedge fund. That's 30% of the registered float, gone in 48 hours. The COMEX is supposed to be the price discovery center of the silver world. But what happens when there's nothing left to discover? What happens when 5 hedge funds decide to take delivery instead of rolling contracts? I'll tell you what happens. The COMEX declares force majeure and settles in cash. It's already written into their rulebook under Section 713. But here's the kicker. If cash settlement happens even once, the entire integrity of the paper silver market collapses. Nobody wants a dollar IOU. They want metal. The whales know it. That's why they're draining the vaults quietly, 1 bar at a time. They're not bidding up the spot price because they don't need to. They're simply removing the oxygen before lighting the match. And when that match hits, $70 silver will be a memory. You'll blink and see $85. This is not a chart setup. It's not technicals. It's a supply crisis hiding behind derivatives. The vaults are empty. The price just hasn't caught up yet. 8. The BRICS just lit the fuse. Silver demand is going global and off the books. Everyone's watching gold. Everyone's talking about central bank gold purchases hitting all-time highs. But do you know what they're missing? Silver is moving even faster, and it's moving in secret. The BRICS alliance, Brazil, Russia, India, China, South Africa, just added 5 new members, including Saudi Arabia, Iran, and the UAE. And while the headlines scream gold-backed currency, the real story is in the infrastructure. These countries are stockpiling silver, quietly and aggressively. Why? Because silver is not just a monetary metal. It's an industrial lubricant for a de-dollarized world. China alone plans to triple solar output by 2027, and each panel requires about 20 grams of silver. Multiply that by 1.5 billion panels, and you're looking at over 1 billion ounces of silver demand from one country. That's more than the entire global annual supply. Now layer on India, who just slashed import tariffs on industrial silver. Then look at Russia, who is converting portions of their sovereign wealth fund into physical commodities. They aren't touching ETFs. They aren't buying PSLV. They're contracting with refiners and securing long-term delivery. Why? Because they don't trust the COMEX. And they don't want their silver priced in dollars. This is the new game. Silver is becoming a geostrategic asset. It's disappearing into vaults that don't report holdings. It's crossing borders without customs codes. It's being embedded in energy, telecom, and defense infrastructure off balance sheet. And here's what most investors don't get. When silver is used in electronics or solar, it's not recycled. It's gone. It's in the landfill or embedded in a circuit board. Permanent industrial burn. Meanwhile, Western investors are still arguing about whether $66.50 was a real breakout. Wake up. The price action is the last signal. By the time you see the spike on CNBC, the metal is already gone. The BRICS just detonated the monetary fault line, and silver is the currency of the new multipolar world. If you're not holding it physically, you're already behind. 7. Artificial intelligence is fueling a silver consumption explosion, and nobody's pricing it. And let me say this as clearly as I can, AI is going to consume more silver than anyone is prepared for. You've heard the headlines. NVIDIA's chips are flying off shelves. Microsoft is building $100 billion AI data centers. OpenAI just announced their next supercluster will require gigawatts of energy. But here's the punchline no one's connecting. AI hardware runs on silver. Every chip, every data cable, every solar panel powering the server farm. They all require high-purity silver paste, silver solder, and silver-coated connectors. And the demand is not linear. It's exponential. According to recent data from Semiconductor Equipment and Materials International, silver demand from chip manufacturers is expected to rise 40% year over year through 2027. That's not a typo. That's a hockey stick. And unlike previous industrial expansions, AI infrastructure is permanent. You don't turn it off. You don't mothball a data center. Once you build the cluster, it runs 24/7, drawing power, requiring maintenance, and consuming replacement components that all rely on, you guessed it, silver. And yet, not a single Wall Street model is pricing this in. The Silver Institute's 2024 forecast still assumes only a 2% industrial growth rate. That's criminally outdated. Meanwhile, TSMC just locked in 5 years of silver paste contracts. Google is expanding their geothermal AI power initiative with embedded silver contact grids. Even Elon Musk is on record saying, "We don't have enough critical metals to scale AI globally. Silver is the bottleneck." But here's the real twist. AI demand is inelastic, meaning they'll pay whatever price is required. If the chips need silver at $100 an ounce, the budget flexes. AI isn't optional. It's an arms race, which means silver's role just evolved from precious metal to strategic input. And this entire sector is still trading like it's 2015. The lag in pricing is your opportunity. Wall Street hasn't connected the dots. But the suppliers have, the refiners have, the whales definitely have. And now you do too. Silver is no longer just a bet on inflation. It's a bet on the next 20 years of civilization. And that reprice hasn't even started. 6. The refineries are at maximum capacity and still can't keep up. Here's a dirty little secret that nobody on CNBC is going to mention. It doesn't matter how high silver goes if you can't get it melted, poured, and delivered. We are not just facing a shortage of silver bars. We are facing a refinery bottleneck of historic proportions, and it is breaking the delivery system in real time. Let me explain. Silver comes out of the ground in raw form. Doré bars, concentrates, scrap. But before it can be sold into the COMEX system, before it can be minted into coins or wired into Tesla's batteries, it must pass through the refiners, the chemical and industrial facilities that purify the metal to 999.9%. And right now, those refineries are screaming. Whether it's Heraeus in Germany, Metalor in Switzerland, or Asahi in the US, they are all reporting record throughput and still falling behind. Why? Because demand is coming from every direction at once. Sovereign mints are begging for blanks. Industrial clients are prepaying for 3-month delivery windows. Retail orders are stacking into Q2 2026. And the real kicker? Refineries can't just scale up instantly. These are not pop-up shops. Refinery capacity requires licenses, compliance audits, waste management systems, and huge capex. You can't just double output in a week. You need years. And no one started that clock early enough. Worse, many refineries are tied to gold output, which means silver piggybacks as a secondary product. If gold ore grades fall, silver refining falls even faster. That's what's happening right now in Mexico and Peru, 2 countries that account for over 30% of global silver production. So we have a triple threat: exploding demand, fixed refinery capacity, and declining ore quality. This is not a delay, this is a structural shortage. And here's the Wall Street kicker. The paper market doesn't care until it does. You can sell as many futures contracts as you want, but if you can't convert those contracts into deliverable bars, the entire derivative structure implodes. The longer this refining logjam continues, the closer we get to that detonation. When the mints run dry, when the COMEX has to declare delivery delays, the price won't just move, it will lurch. And when it does, it won't stop at $70. 5. The vault leasing scam is unraveling, and it's about to detonate. The illusion of supply. If you think the silver market is honest, I've got some beachfront property on the moon to sell you. Because what I'm about to explain is the biggest shell game in the financial system, and it's about to collapse. It's called vault leasing, and for the last 20 years it's allowed banks to report silver holdings they don't actually control. Here's how the scam works. A bullion bank, let's say HSBC, leases 10 million ounces of silver from a central bank or a sovereign wealth fund. They get the bars, store them in a vault in London or New York, and show it on their books as assets under custody. But then, they turn around and lease those same bars again to a hedge fund, or a jewelry conglomerate, or a sovereign mint. Now the bars are in the same vault, but 2 parties think they own them. This is called rehypothecation, and it's legal. But it's also a time bomb, because when both parties ask for delivery at the same time, boom! There's only 1 bar, 2 claims, 1 lawsuit. This isn't a theory. This is already happening. Earlier this month, a Hong Kong-based bullion fund filed notice in London after being denied withdrawal of 2 million ounces they were guaranteed in their custodial agreement. The vault said the bars were unavailable. Translation? They're gone. And this is just the tip of the spear. According to the LBMA's latest transparency initiative, nearly 70% of all vaulted silver is encumbered in some way, leased, loaned, or promised elsewhere, which means that the available supply is a total fantasy. And here's the sick irony. This system only works when everyone trusts the vaults, but once that trust is broken, when a few whales start demanding delivery, when 1 or 2 court cases hit Bloomberg, the panic begins. Everyone tries to grab their bars at once. The vaults go silent. The settlement offers come in. And that's when the price of unencumbered silver detaches from the paper market entirely. We are not talking about $70 silver. We are talking about a new pricing tier. Cleared and physically held. In that world, $100 is just a starting point, because now you're paying not for silver, but for certainty. 4. Sovereigns are preparing for dollar default, and silver is the hedge they're not talking about. Let me say this with absolute clarity. The United States is on the brink of a debt spiral, and sovereign nations are not waiting to see how it plays out. They're repositioning now, quietly, urgently, and silver is one of their silent weapons. We already know that central banks have bought more gold in the last 24 months than in any other period since 1967. But what they're not telling you is this. Many of them are also buying silver, but they're doing it off-book, through proxies, through refiners, through sovereign investment vehicles. Why? Because silver is the off-the-radar hedge. Gold is politically visible. Everyone tracks it. But silver flies under the wire and has industrial camouflage. It's a monetary asset disguised as a commodity, which is exactly what you want when you're preparing for the end of a currency regime. And make no mistake, the dollar is dying. The U.S. just added $1.1 trillion to its national debt in 90 days. Interest on that debt is now consuming over 40% of federal tax revenue. This is not sustainable. This is terminal velocity. And foreign creditors, Japan, China, Saudi Arabia, know it. They're slashing treasury holdings. They're trading oil in yuan. They're launching bilateral settlements with gold. But behind the scenes, they're accumulating hard, deliverable, non-sanctionable metals, and silver fits that bill better than anything. It's small, divisible, untraceable, and essential to every industry of the future. Solar, EVs, AI, semiconductors. And here's the kicker most people miss. If a dollar default does happen, if the Treasury has to restructure, or the Fed begins overt yield curve control, the dollar will drop fast. That's when silver explodes. Not by 10%, not by 50%, but by 200% or more, overnight. Because unlike gold, silver has a much smaller monetary base. It's thinner, more volatile. And once the sovereigns step in with serious capital, the repricing will look like a crypto pump, but 10x more permanent. Think $65 is expensive? The central banks don't. They're already preparing for a two-tier pricing system, one for paper, one for nations. When the dollar burns, silver becomes the fire escape, and it's not big enough for everyone to fit. 3. The mining industry just flashed the red warning light. Above ground, supply is flatlining. If you think silver can just be mined into supply whenever the price goes up, I have bad news for you. You've been sold a fairy tale. This isn't oil. This isn't copper. Silver production is structurally broken, and it's been broken for years. Let's run the numbers. Global silver mine output for 2024 is estimated at 830 million ounces. That's barely a 1% increase from last year. In fact, despite record prices, the mining industry has failed to increase silver output meaningfully for almost a decade. Why? Because most silver doesn't come from silver mines. It comes as a byproduct of lead, zinc, and copper. If those metals aren't in high demand, silver production collapses. That's exactly what's happening now. Copper mines are cutting capex. Zinc mines are shutting down. And pure silver mines? There are only a handful globally. Fresnillo, Hochschild, First Majestic. And guess what? Their reserves are declining. It takes 7 to 10 years to bring a new silver mine online. That means even if the price goes to $100 tomorrow, we won't see fresh production until 2032. Worse, ESG regulations are choking off permits. In Peru and Mexico, the top two producers, new projects are getting blocked over water rights, land disputes, and environmental red tape. That means even the mines that could help can't legally operate at full capacity. Meanwhile, demand is growing exponentially across EVs, AI, solar, defense, and sovereign hedging. This isn't a gap, it's a chasm. And here's the part most analysts don't see. Above-ground inventories are already gone. According to Metals Focus, Identifiable silver inventories have dropped by over 25% in just the last 18 months. We are running on fumes. The paper market can pretend all it wants, but the real world is about to scream. When the miners can't deliver and the vaults are empty, the pricing mechanism goes vertical. This is where you see $65 jump to $100 not in years, but in weeks. There is no supply response coming. The reprice is not a maybe, it's a schedule. And the clock just struck midnight. 2. The energy crisis is the silent hand pushing silver to the moon. Here's what 99% of analysts are missing. Silver is not just a precious metal. It's energy. Let me say that again. Silver is embedded energy. Every solar panel, every EV charger, every wind inverter, they all require silver to capture, convert, or control power. And as the global energy crisis deepens, silver becomes the conductor of the entire transition. Let's break it down. According to the International Energy Agency, renewable energy capacity is set to grow by 50% between now and 2030. Solar will be the largest slice, and silver demand per solar panel is actually increasing, not decreasing, due to higher efficiency cells that require more silver per watt. This alone could push industrial demand to over 1.2 billion ounces per year, far beyond total global mine supply. But here's the kicker. Silver is not just used to generate power, it's used to move it. High-voltage grid systems need silver-coated contacts. Nuclear plants require silver-based neutron control rods. Even hydrogen fuel cell systems rely on silver-catalyzed membranes. It is everywhere, and it's irreplaceable. Copper doesn't cut it. Aluminum degrades too fast. Only silver works at scale with minimal resistance and thermal stability. Now let's bring in the pain. Energy prices are rising. LNG is spiking. Oil just crossed $90 again. That means the cost to mine, refine, and move silver is rising. At the same time that demand is exploding. What does that mean? It means the cost floor is rising. It means the replacement cost of every ounce of silver is now well above $70. And yet the market is still pretending that $65 is the top. It's not. It's the baseline. You're buying silver below cost, below future replacement, below strategic value. It's the equivalent of buying oil at $10 in 2003, before it ran to $147. This is the final mispricing. The one that doesn't come back. Energy is tight. Grids are stressed. Renewables are scaling. And silver? Silver is the wire that connects it all. When the world wakes up to this, the repricing won't be orderly. It will be violent. The fuse is already lit. The burn has begun. 1. The dollar. Itself is the final catalyst, and silver is the mirror that reflects its collapse. Here we are, the final piece of the puzzle, the last domino. And it's the biggest one, the US dollar. You want to know why silver is being repriced right now? It's not just gamma squeezes, it's not just supply shocks or refinery bottlenecks or mining stagnation. It's because the dollar, the measuring stick of the entire financial system, is rotting from the inside out. And silver is the mirror that reflects that rot. Let's talk facts. U.S. M2 money supply exploded by $6.3 trillion since 2020, but GDP didn't grow by even a third of that. The difference? That money wasn't earned. It was printed, injected into a system with no productivity to back it up. That's dilution, and now the effects are compounding. The dollar has lost over 17% of its purchasing power since 2020, and that's using official CPI. Real-world prices, food, shelter, energy, are up by 30% or more. The Fed can't raise rates anymore. The Treasury can't sell enough bonds. Foreign buyers are stepping away. And inside this pressure cooker, silver is starting to scream. It's not going up because it's getting more valuable. It's going up because the dollar is dying. Quietly, structurally, irreversibly. And here's what terrifies the system. Silver isn't just a commodity. It's a vote of no confidence. It's a liquid default hedge. When you buy silver, you're not just acquiring metal, you're exiting the fiat game. And the banks hate that, because every ounce of physical silver that disappears into private hands is one less ounce they can use to suppress price, lease out to shorts, or paper over with derivatives. This is why the battle for $65 was so violent. It wasn't just technical resistance, it was psychological warfare. It was the last line before public perception changed, before the crowd realized that silver is not stuck. The dollar is falling. And when that idea takes root, you get the final reprice. The parabolic moment. The moment where silver stops trading in dollars, and dollars start being priced in ounces. That's not hyperbole. That's the endgame. You are not early. You are not late. You are right on time.